So, because banks affect the overall level of the money supply, and because we have this whole issue of banking panics, governments have often considered it to be in their interest to have some level of bank regulations. Now, we know that the bank money creation under fractional reserve banking, we know that the strength of that process influences the money supply. And so historically speaking, governments have wanted to make sure that the banking system was stable, but also have an interest in maintaining a stable money supply as well as a stable banking system. Nowadays, of course, we have fiat currency. So this actually becomes much less important, because if the banking system starts to be disrupted, yes, that impacts the money supply, but the government can offset any fall in bank money creation. So this whole issue of liquidity reserves made some sense when we had a gold standard economy, because we couldn't just summon up more gold in an instant. But once we have paper money, and even more so electronic money, then this issue is not important with fiat money. But what is important is this issue of bank capital and leverage. So it might have been a long time ago that banks believed that they would not be bailed out. And if they believed that they would not be bailed out, and if the people who were lending money to the banks believed the banks would not be bailed out, then some self-regulation might have been plausible. And if we go back and look and say, for instance, the 1800s, before there was systematic regulation in the United States, what we find is that leverage ratios were typically about 6-to-1. That is, remember, the leverage ratio is total assets over equity capital. And maybe even as low as 4 or 5-to-1. So, what happens, though, is that the banking industry eventually comes under some regulation, and the government also, in the wake of things like the Great Depression, when we had 3 different waves of banking panics come and destroy a large fraction of the U.S. banking system, the government goes ahead and makes the promise to cover people with deposit insurance. So deposit insurance addresses this question of liquidity reserves, but it ultimately has a little bit of an unfortunate impact, because the government has now basically guaranteed the banking system to some extent. So once it becomes clear that there's some degree of implicit or implied guarantee that creditors, people who lend money to banks, won't be totally wiped out, then this means that creditors pay less attention to the bank's level of equity capital, because they worry less about the bank having enough money, because they think that the government will bail them out. And so slowly, over the post-World War II period especially, we see that leverage ratios go up and up and up and up, until finally, by the time we're in the early 90s, leverage ratios in approximately the 10 to 15 range. Now, what happens then is that if a bank has a $1 increase in its equity capital, then it can increase its total assets, the total amount it lends out, say for instance, by $15. And so this leads to a banking system able to rapidly expand lending. And that may be a good thing. But it also means that when banks experience capital losses, bank lending falls dramatically. So again, if a bank is determined to have a 15 to 1 leverage ratio, a $1 increase in equity capital leads to $15 more loans. But it's also true that a $1 decrease in equity capital leads to $15 less in loans. So this issue of the leverage ratio bears on how stable the banking system is. And essentially, a high leverage ratio means the banking system fluctuates more. So, when times are good and banks want to expand lending, they're going to be able to do that more easily. And if you're thinking about financing, some sort of railroad boom back in the old days, or a boom in internet startups or something like that, then it may be useful to have a banking system that can expand rapidly to lend to these newly booming industries. On the other hand, it may also potentially lead to speculative bubbles. And I think it's probably true that speculative bubbles come in more and less harmful varieties. In the 1990s, in the internet tech bubble, it was mainly shares of stock that were entering a bubble, and most of those investments were taken without borrowing. People just bought stock. They didn't borrow money to buy the stock mainly. So that when it popped, we didn't have this issue of people having a lot of unpaid debts. One moment they thought their 401k was worth $500,000, and then a couple months later, they may have realized that now it's only worth $400,000. But we didn't reach this area where we had all these bankruptcies and everything's all thrown into confusion. In the 2000s housing bubble, of course, a lot of this was financed by leverage, both on the part of the banks and on the part of the homeowners. And this ended much worse. When this levered bubble pops, it calls into question who's going to get repaid on their debts, and this triggers a more general, or has the risk of triggering, a more general financial crisis. Whereas the bursting of the tech bubble was unlevered or unleveraged, and when it popped, there was no general financial crisis. So, in the aftermath of the housing bubble and the financial crisis in the 2000s, we are having some limits on the leverage that banks can undertake. These are still relatively modest limits, Before the financial crisis, banks were able to leverage up to 33 to 1, which is pretty crazy. That's essentially the same as putting 3% down on a house. Now I believe that they're going to be limited to something like 20 to 1, which is more like putting 5% down on a house. It's better, but I think there's still probably a lot of room for improvement to make the financial markets more stable.